The fractional reserve banking system, established in the United States with the first bank in 1791, allows banks to create money through loans for both real property, such as land, and consumables, like bubblegum, contributing to a money supply of $21,560 billion in January 2025. This essay explores an alternative monetary system where money creation is restricted to loans for real property. Assets like land, houses, and other tangible goods with a high probability of maintaining or increasing value, while loans for consumables incur debt without expanding the money supply. By prioritizing assets with intrinsic or historical value, such as land, and categorizing other depreciable assets like cars or planes, this system aims to enhance economic stability. The essay examines how this system would function, its implementation overnight or over time, its historical implications if adopted in 1791, and the economic ramifications for individuals, banks, and the nation. Designing a real property-based monetary system. In the proposed system, money creation occurs only when banks issue loans for real property, defined as assets with enduring or appreciating value. Land, with its finite supply and intrinsic worth for agriculture, housing, or commerce, serves as the primary asset. Houses and buildings, historically appreciating but occasionally depreciating, qualify as secondary assets. Depreciable assets, such as cars, planes, or boats, which retain some value even as scrap, are evaluated based on historical appreciation, utility, and residual value. Consumables, non-durable goods like food or bubblegum, which are consumed and leave no value, e.g., food becomes waste, bubblegum is discarded, do not trigger money creation. Instead, loans for consumables generate a distinct type of debt, requiring banks to hold higher reserves than the typical 10% to mitigate risk. Money creation for real property. When a bank issues a loan for land, valued at $300,000, it creates a deposit, increasing the money supply. The loan is secured by the land, which retains intrinsic value regardless of monetary fluctuations. For houses or buildings, loans reflect their historical tendency to appreciate, though depreciation risks, e.g., market downturns, are considered. Depreciable assets like cars, valued at $30,000, qualify if they demonstrate residual value, e.g., scrap metal or resale potential, with banks assessing their longevity and market stability. These loans expand the money supply, as the assets back the debt with tangible worth, aligning money creation with wealth that endures. Debt for consumables. Loans for consumables, such as a $1 credit card purchase of bubblegum, create debt without increasing the money supply. Banks issue these loans from existing reserves or deposits, requiring higher reserves, perhaps 20% or more, to cover the risk of unsecured debt, as consumables leave no collateral. This non-monetary debt is repaid without generating new deposits, preventing inflation from transient purchases. For example, food, consumed to sustain human function, results in waste with no intrinsic value, unlike land or cars. Bubblegum, chewed and discarded, epitomizes this waste, highlighting the flaw in equating it with land in current policy. Asset evaluation. Identifying qualifying assets involves clear criteria. Land, primary asset due to finite supply and intrinsic value. Buildings, secondary assets, evaluated for historical appreciation and market stability. Depreciable assets, cars, planes, or boats qualify based on residual value, durability, and resale potential, excluding items with negligible scrap value. Exclusions: consumables, food, bubblegum, and items with no lasting value are ineligible for money creation. Banks would use historical data, market trends, and appraisals to categorize assets, ensuring only those with a high probability of maintaining or increasing value expand the money supply. Implementation and economic effects. Overnight implementation. If this system were implemented overnight in 2025, the economy would face significant disruption. The current money supply, $21,560 billion, includes money created from consumable loans, part of the $20,400 billion in household debt in 2024. Halting money creation for consumables would freeze credit card lending and unsecured loans, shrinking consumer spending, which drives 70% of U.S. GDP. Retail sectors, reliant on consumable purchases, would contract, causing job losses and business closures. Banks, required to hold higher reserves for consumable debt, would face liquidity strains, potentially leading to failures without Federal Reserve intervention. However, prioritizing real property would redirect lending toward assets like land and housing, stabilizing the money supply by tying it to tangible wealth. The national net worth, $150 to $200 trillion, includes $48,200 billion in real estate, suggesting a robust foundation. Inflation risks would decrease, as money creation aligns with appreciating assets, but reduced consumer spending could trigger a recession, disproportionately affecting lower-income individuals reliant on credit for daily needs. The Federal Reserve would need to adjust monetary policy, possibly lowering interest rates, 4.75% to 5% in 2025, to ease the transition. Gradual implementation. A phased implementation over 10 to 20 years would mitigate disruption. Banks could gradually reduce consumable lending, transitioning to non-monetary debt with higher reserves, e.g., 20% over 5 years. Simultaneously, incentives like lower interest rates for real property loans could shift borrowing toward land and housing. Regulatory changes, enforced by the Federal Reserve and Treasury, would standardize asset evaluations, ensuring consistency. Public education campaigns would encourage investment in real assets, reshaping consumer behavior. Economic effects would include slower money supply growth, stabilizing currency value and reducing inflation risks. Real estate markets would thrive, potentially increasing the $48,200 billion real estate sector, but risks of asset bubbles, as in 2008, would require oversight. Consumer spending would shift toward durable goods, reducing retail volatility but impacting consumable industries. Individual economies would adapt, with wealthier households benefiting from property investments, while lower-income individuals might face credit constraints, necessitating government support like subsidies for essential consumables. Stability and fluctuations. This system would enhance economic stability by anchoring the money supply to real property, which constitutes a significant portion of the national net worth. Unlike consumables, which vanish, land and buildings endure, reducing the risk of currency devaluation from overlending, as seen in hyperinflation cases like Weimar Germany. Higher reserves for consumable debt would strengthen banks, minimizing failures during downturns. However, fluctuations could arise from real estate market volatility or overinvestment in depreciable assets, requiring Federal Reserve intervention to balance liquidity and prevent bubbles. Historical context. Implementation in 1791. If this system had been implemented in 1791 instead of the current fractional reserve model, U.S. economic history would have diverged significantly. In 1791, the money supply was $10 to $15 million, and banking was localized, with loans primarily for trade or land speculation. A real property-based system would have aligned with the era's land-centric economy, as homesteading was common and consumable borrowing was minimal. The first bank could have restricted money creation to land and buildings, fostering a stable currency tied to the nation's vast land resources. Economic growth would have been slower, as consumable lending, which fueled later consumer economies, would have been limited. The Industrial Revolution, reliant on credit for machinery and trade, might have been delayed, but land-based wealth would have supported steady expansion, avoiding the instability of the 1836 to 1913 period without a central bank. The Federal Reserve, if established in 1913, would have focused on real property markets, potentially preventing speculative bubbles like the 1929 crash. The money supply, $20 billion in 1913, would have been smaller but more stable, reducing inflation risks. However, this system would have constrained consumer-driven growth in the 20th century, limiting the retail and service sectors. The national debt, $36 trillion in 2025, might have been lower, as government borrowing would rely on asset-backed financing. Inequality could have worsened, as land ownership concentrated wealth, marginalizing those without property access, a challenge in 1791's frontier economy. Ramifications and policy considerations. Whether implemented overnight or gradually, this system would reshape the economy. Overnight adoption would disrupt consumer spending and banking, risking recession but stabilizing currency value. Gradual adoption would smooth the transition, fostering a real property-driven economy with reduced inflation but potential inequality. Historically, a 1791 implementation would have created a land-based economy, slower growing but resilient, avoiding some modern financial crises. The global money supply, $100 to $115 trillion in 2025, suggests similar reforms could apply worldwide, tying money creation to real assets like land, valued at $350 trillion globally. However, consumable debt's role in driving consumption highlights a trade-off: stability versus growth. Policymakers would need to balance incentives for real property investment with support for consumable access, possibly through non-debt mechanisms like universal basic income. In conclusion, a monetary system restricting money creation to real property, with land as the cornerstone, would enhance stability by aligning the money supply with enduring wealth. By distinguishing consumable debt, requiring higher reserves, and excluding it from money creation, this system addresses the flaw of equating land's intrinsic value with bubblegum's ephemerality. While implementation poses challenges, its focus on tangible assets offers a path to a more resilient economy, reimagining the fractional reserve system established in 1791 for a stable financial future.